Hey, what's up, guys? Today I wanted to share 5 uncomfortable truths about yield farming that nobody talks about, and I'll be going over in detail in each one, share a few tips and tricks, as well as some mistakes to avoid so that you don't lose money yield farming in the process. If you're new here, my name is Richard. I've made a few $100,000 from crypto, but I've also lost a lot of money yield farming concentrated liquidity pools as well. So that's why I'm making this video. So hopefully you can learn from some of my mistakes. The first is to understand that yield farming is not easy. It takes a while to learn about like the different concepts that you see on my YouTube channel. I'm not going to sugarcoat it and say that you can learn this stuff like very easily in like a week or two, right? There's a lot of things to learn, like stuff like internal loss, what ranges to set, different strategies like delta neutral strategies, hedge strategies, or using leverage, or how to use your overall portfolio, how to structure it to match your risk profile. All of that would take a lot of time and effort to learn, right? So on this topic, I'll share 3 quick mistakes why people lose a ton of money when yield farming concentrated liquidity pools. And most people do lose money. It's not an exaggeration when I say it. I've talked to a ton of yield farmers. Typically, they lose money first before they start learning about the process and become more consistently profitable, right? On the surface level, it seems very simple. You just set your range around like 100, 200% APR and print the fees, right? But a lot of times we don't know the risk that we're taking, especially if you are new to yield farming. The first mistake that a lot of people make is the asset selection. They're providing liquidity for assets that they would not normally buy or hold for the next 6 to 12 months, simply because they're blinded by the APR, right? They see a lot of volume flowing through, stuff like newer launches or meme coins. Maybe they didn't actually research deeply into the token and understand like the risk behind it. And then they're buying because of different reasons like the hype, the APR, and everything just looks very attractive, right? But in reality, you have to be very careful with what you're providing liquidity for, especially in today's market where not everything is pumping right now. If the market is really risk on and everything is pumping, then of course it's much easier to select outperforming assets, right? So if you tighten your asset selection, you still might lose money in the process, but at least if you're actually more intentional about it, the chance of you actually losing money from yield farming is going to be way lower than if you're not doing the research, you're doing the spray and pray approach, or you're just not being very intentional about what you're yield farming, right? So I always try to yield farm assets that I want to hold for at least the next 6 to 12 months and ideally longer. Stuff that I would be actually comfortable holding or buying into the bear market. And these could be blue chip pools as well, like stuff like Ethereum to USDC. I'm very comfortable with Ethereum. I know what to expect. I believe the growth long term. So even if Ethereum's price dropped by 70%, I would actually be happy because I could be buying more Ethereum, right? So the asset selection part is very important. And the second mistake I see all the time is the ranges is too tight. If you're earning 100, 150% on a lot of these blue chip pairs like Ethereum to USDC or even Solana to USTC, oftentimes you're actually squeezing the range to be too tight. When your ranges are too tight, you're going to lose a ton of money in the process. I'll go over this a little bit more in detail about like range chasing and why setting a tight range is typically not a profitable strategy. But basically, if you set the range too tight, you're going to have more internal loss. You're going to miss out on more capital gains if the prices move up. You're going to have more capital losses if the prices move down. Simply because if you squeeze the range, your exchange rate when people swap token is going to be very aggressive, right? For example, Ethereum right now is trading at 4,500. If you had a range at like, let's say $4,000 to $5,000, when prices move up or down, you're getting an exchange rate in that zone, right? Your average exchange rate is going to be around $4,000 to $5,000, but that's not a good exchange rate if Ethereum's price go up to 7,000 to 8,000, or if the price goes down to like $2,000 to $3,000. So you definitely don't want the ranges to be too tight. But actually, the bigger problem is that you're not going to be able to stay in range for an extended period of time. The APR metric is if you are able to stay in range for an entire year. Let's say it's 50% APR, you're able to stay in range for 1 year, then you're actually making that 50% in cash flow, right? But if you're actually only able to stay in range for like 1 to 2 months at a time and you're forced to rebalance, a lot of times you're actually locking in a lot of impermanent loss. If you don't know how much you're locking in beforehand, it oftentimes will lead to a lot of trouble, especially if the market is very volatile, but the volume is not that much, right? Which is kind of what we're seeing right now in the market. And the third mistake is too much size on a riskier play. So it depends on your own risk tolerance. For example, if you are more comfortable yield farming larger cap altcoins, you could be risking more assets there. But if you're actually putting in a ton of your portfolio in like lower caps that you have no good thesis on or like different meme coins, you're often taking too much risk, right? Let's say you're putting like 30% of your portfolio into each like yield farming position that are very high risk. If these tokens never recover in price, you're going to lose a ton of your portfolio, right? So make sure you control your sizing. For most cases, I like to keep my sizes pretty low, around like 5 to 10% of my portfolio, sometimes a little bit bigger if it's a larger cap token. But there are some exceptions as well, like Pixel. That's my conviction bet for this cycle. But I've also bought a lot of it at a cheaper price. So my cost basis is pretty much covered for that investment. So make sure you're not making these mistakes. And the second uncomfortable truth that I want to share is that you have to be comfortable with unrealized losses. So a lot of times when we are yield farming these assets, we have a good thesis behind it. Sometimes it is a good idea to cut your losses and move on to the next assets if your thesis is proven wrong and it did not play out, right? But we want to be comfortable with the unrealized losses for the assets that we believe in. For example, I really like Pendle, but if you look at the Pendle to ETH chart, the green line is my entry, is trading slightly below my entry. So I am suffering some negative impermanent loss where I would be losing Ethereum in the process. And typically when I enter into these pools, I am holding Ethereum to begin with. So my goal is to stack more Ethereum, right? It doesn't matter if I make a US dollar profit, but an Ethereum loss. I want to try my best to avoid that and try to close my positions at an Ethereum profit. But you can see because a lot of altcoins are pretty weak compared to Ethereum, I am sitting on some unrealized profit here if I am measuring my profit and loss with Ethereum. And I like to do that again is because if these altcoins are not outperforming Ethereum in the long run, then it would be better for me to just buy Ethereum in the first place, right? You can see it's suffering a negative divergence loss here. If I close out my position into Ethereum for this Pendle to ETH pool, I would be losing about 5% of my initial capital. So it doesn't matter like how much APR you earn. If you close your position at a loss and sell into Ethereum, then you are losing money in the process, right? It's still outperforming holding by just a little bit. So it is better than me just buying and holding Pendle. But ideally in the next 6 to 12 months, I want to see some Pendle outperformance to close this position in Ethereum profit. But I'm comfortable with this asset. That's why I'm yield farming this in the first place. If Pendle keeps going down, I will be buying more Pendle. So I'm not really worried about this. And sometimes if the pool has enough APR, you are able to outprint like the negative divergence loss here. For example, this MOG to ETH pool. But MOG, I would argue, is still a much higher risk than buying stuff like Pendle, right? But over a longer period of time, you can see this position age is around 200 something days. The APR is able to outprint this divergence loss here with a wider range setup. So that's why I prefer a wider range as well. The conversion rate is going to be less aggressive. And there are scenarios where you're still coming out on top, even if the asset do depreciate in value. But in any case, you want to be yield farming assets that you believe in. For example, I'm very bullish on Pixel. I'm fine having a larger position, and you can see it's still beating just buying and holding Ethereum and Pixel in the market, right? Even though I'm sitting in some unrealized loss here, about 4 something percent on my initial investment. This position has been live for about 50 something days. But if I could turn this around in the next 6 to 12 months, then this position is completely fine, right? And I'm yield farming these altcoins in the first place is because I believe that these altcoins would outperform Ethereum and I will be able to close these positions in a Ethereum profit. But if these altcoins don't outperform Ethereum, you will be sitting in a ton of unrealized losses that you might be forced to realize later on. So you got to be very comfortable sitting in unrealized losses. If you are not, then you shouldn't be taking that risk, right? And this is very true for every other asset as well. If you're buying Bitcoin right now, it's roughly like 124K, right? If Bitcoin drops down to 70K, you should be very comfortable with it. If you're not, it's very likely that you don't actually believe in the asset or that you over allocated to that asset, right? So before you buy anything, it's always helpful to look at the risk and the maximum drawdown that you could expect from an asset. And the third thing I want to share is that high APR doesn't mean a high profit. So typically, if you guys are squeezing the range with concentrated liquidity pools, earning a very high APR, chances are you're not going to earn a high profit if the strategy is not sustainable. And this is especially true if the market is very weak and the prices do move down a lot. If you're earning a ton of APR or if the market whipsaws, you're going to be locking in too much impermanent loss. So in my opinion, it's always a bad idea to chase the APR. So let me show you an example of this so that you know exactly what I'm talking about. If I pull up DeFi here, which is a very popular platform for yield farming concentrated liquidity pools, and what it does is it automates like the yield farming process for you, right? If we filter by total value lock, what people are depositing in are mainly these pools for Ethereum and USDC. I could click into it, for example, this Pancake Swap Vault. And if I zoom out to 1 year, you can see they're following a range chasing strategy. This is a strategy that I do not like at all. If we look at the APY throughout the whole process, the average APY is about 50 something percent. So really solid APY. But what I want to show you guys is this price tab. You can see that the price actually did not recover fully yet. 1 year ago, when Ethereum is trading at 2,400, the price for this vault is around like 800 billion, right? And right now, the price is still at around like 700 billion. So this is still sitting at like 100 billion loss. So if you've actually deposited in this vault and you stayed in this vault, you would have lost a lot of money in the process, right? You could have just been buying and holding Ethereum and you would be up almost 2x from the initial investment. This is why I say, yield farming is not easy. A ton of people are undereducated about it. That's why I also created an online course. A lot of people have been asking me about yield farming and stuff like that, right? If you've been watching me for a while and you want to check it out, the early enrollment is open. You could check out the link in the description or go to drippy.finance. But basically, a lot of my course is about helping you avoid these mistakes that will lose you a ton of money in the long term. If you put in like 100K into this position and you're down about 10%, you would have lost like 10 grand, right? So that's something to consider when you guys are investing into DeFi. This position is not very profitable because the impermanent loss is simply too high. They're chasing the range downwards by rebalancing. What you're essentially doing is that you're actually selling your assets at a cheaper price. And when you're rebalancing upwards, you're buying an asset at a higher price, right? If you keep this up over a long enough time, you will lose money if the fees you earn does not cover that process. So that's why I don't like this range chasing strategy, especially if the APR is not very high. It's not going to be very profitable. And even if the APR is very high, I find that the wide range strategy is going to be more profitable over the long term. So high APR definitely does not equal to high profit. You don't want to over optimize for APR. What we want to actually look at is what we take home at the end of the year. So I always optimize for more profit rather than more APR. It doesn't matter if I earn like 10, 20% APR, but my gain for the year is like 50 or 60% on my portfolio, right? So that's something to really understand. Don't be tricked by the APR. A lot of people like to post on X or on YouTube, like, okay, I'm earning this high APR with this strategy, but over a long enough time, like let's say 6 to 12 months, a lot of these strategies actually don't pan out over the long term. Simply because with the tighter range strategy, it's very hard to manage or to minimize the impermanent loss that you're locking in. And sometimes when you're trying to minimize your impermanent loss, you're going to be lowering your APR by widening the range. So you definitely don't want to set your ranges too tight. And number 4 is every portfolio is different. So if you guys look at my current portfolio right now, I'm pretty altcoin heavy, and especially in Pixel, this is my conviction bet, like I've said earlier, right? But this doesn't mean that you should be following my portfolio. I'm not 30 yet, and I have other sources of income and other investment. So I am taking a bigger bet on like a specific ecosystem that I would believe would pull like a 50x or an 100x. So if that happened with Pixel, my portfolio would change a lot. But I'm also taking a bunch of risks here because Pixel is a lower cap token. There's no products yet. It's still in development. So that's something to consider. There's a lot of risk going into it. And this definitely should not be your portfolio if you're like 60 and you're close to retirement, right? Or even if you're in your 50s and you don't want to spend the time to recover your portfolio, you definitely don't want your portfolio to be too high risk. So something to consider is that the younger you are, or the higher the ability to earn your income is, the easier it is to take more risk. Because even if you lose a bunch of your investment income, you're able to put your active income into the portfolio and grow it over the long term, right? And alongside this, I do very conservative investment strategies as well. Like, for example, dollar cost averaging Bitcoin. I've been buying at least $500 worth of Bitcoin every single month, regardless of price, right? So that's how I kind of balance the risk a little bit. You can see in January, I only have like 0.0167 Bitcoin. And thanks to yield farming, I now have 0.0767 Bitcoin while I am accumulating these other assets like Pixel as well as some Ethereum. So you should definitely not be copying my portfolio. I do have client portfolios that I help manage that have like 80% blue chip assets on stuff like Bitcoin and Ethereum and some stable coins. And another 20% is into these higher risk, higher reward altcoins like Pixel or Pump. This is going to allow us to balance the risk and reward. If you do like an 80% blue chip and then a 20% altcoin portfolio, right? That's typically the best for most investors. You definitely don't want to be heavily allocated to altcoins like I am. Again, my risk is my risk, your risk is your risk, right? So every portfolio is different. Don't just copy a portfolio allocation. You want to ask yourself like, okay, what's my risk tolerance? Can I see my portfolio getting cut down by 70 to 80%? If you can't, then maybe you should be adding more Bitcoin, more Ethereum, more stablecoin to your portfolio so that your drawdown is going to be less than 70%, right? Maybe your drawdown is 30 to 40%. That's where you still feel comfortable, a little bit stressed maybe, but not losing sleep over. If you're losing sleep over stressing about crypto, you typically are taking much more risk than you realize, and you want to kind of lower it a little bit by allocating into more major assets and into stuff like stablecoins to reduce the volatility. And the fifth thing that I want to share is that typically higher rewards always comes with higher risk. A lot of times when you do risk analysis, we really want to look at like, how can we lose money? How much can we lose? A lot of times these higher reward strategies like setting the range really tight or using leverage or investing into altcoins, these come with higher risk. And if you mix too much of the risk, for example, you're running very tight ranges and you're yield farming high risk altcoins at the same time, you're actually taking a lot of risk. And that could be fine if you're using like 1 to 2% of your portfolio. You don't care if you lose that amount, then that's completely fine. But if you're putting like 80% of your portfolio in like these hybrid strategy, you could end up losing a ton of money in the process. And this is one of my favorite charts that I like to share is because this is very simple, but it holds a lot of truth. There are bad investments where the risk is very high, but the reward is very low. So you want to avoid these at all costs, right? This could be stuff like lower cap meme coins that someone just launched like yesterday. If you want to gamble with that, then you definitely don't want to put your whole portfolio in it. But there are also lower risk investment that has a lot of reward. So this type of investment is actually very hard to find. And it also depends on the market condition, right? For example, the huge dump that we saw in the altcoins a few months back, there was a ton of opportunity to buy stuff like Ethereum for below like $2,000, right? Which has like some risk to it. And the potential reward is really high because if we did see Ethereum trading at $4,000 before it dipped below $2,000, right? So we know that that asset could at least go up to $4,000. And right now it's trading above that level. So there are times where the investment is really great and that the risk is very low when you're taking that swing. But this is very hard to find. So most investment will actually stay on this risk line, right? And a lot of times when people find great investment, what is going to happen is that rewards are typically going to drop to match the risk because the prices is going to move up, right? For example, Ethereum jumping from like 1500 to about like 4500 right now, it's still a great investment in my opinion for the next decade, but then the reward dropped because the price went higher. If you buy at 4,500 and Ethereum goes up to $10,000, you're going to make less money than if you bought at like 1,500 and the price goes to $10,000, right? So the reward would always match the risk over a longer time period. So we want to keep this in mind if we're using different strategies to optimize yield and stuff like that. Typically, you are taking on more risk. So even stuff like yield arbitrage with platforms like Contango, you are taking on more risk. You need to know how to manage your risk really well so that you don't lose a ton of money if things do go wrong. So one of the strategies that I've shared earlier is using some of the fees to dollar cost average Bitcoin or to sell to stable coins, right? This is especially important if you guys have a very altcoin heavy portfolio. You don't want to be rolling everything into altcoins because altcoins typically like go up by a ton in a short time period, but they also drop fairly quickly as well. So we want to be very careful with the risks that we're taking and make sure that you're not taking the risks that you're uncomfortable with, right? For example, I'm a very high risk investor. I like to take more risk because I could afford to lose these investments. If you cannot do that, then we want to stick with like lower returns, but lower risk investment, stuff like Ethereum to USDC. And this is especially true if you guys have like 7 figures, 8-figure portfolios. You've already made it. You don't need to risk your portfolio to grow it to like 9 figures or 10 figures, right? Just take safer bets and then allocate a small portion of your portfolio to like the riskier investment. So that's pretty much it for this video. And just a quick recap. Like the first thing is to realize that it's not easy, right? Yield farming is not easy. You do need to spend time and effort to learn it. But if you stick with it, you will get better at it. That's why it will feel easier as long as you keep learning and just stick with this thing. And the second is you got to be comfy with unrealized losses. If we did not get in at a perfect entry, and we typically do not get in at the best prices, we have to be comfortable with unrealized losses. And we actually have to believe in the assets that we buy so that we don't sell at a loss. The third is that the high APR doesn't equal to more profit. I personally like to optimize around profit rather than APR. The fourth is that every portfolio is different. Don't just copy my portfolio. You should be doing your own research and actually investing in a way that matches your risk profile. Again, I'm not in the business of giving financial advice, telling you what assets to actually invest in. I'm telling you where the risk is, where the potential rewards are, what strategies that I use, but you should not be actually doing everything that I do, right? Because we're completely different and the way we manage our positions could be different as well. And the fifth thing is that high reward typically means higher risk. So that's it for this video. And lastly, before I hop off, be sure to check out our website at drippy.finance if you want to level up your DeFi skills, learn my exact strategies, and it is open for early access. We still have about like 10 spots left before I close it for now because I want to make sure that the quality is high. I'm giving a lot of early sign-up bonuses like one-on-one coaching sessions. That's why I got to cap the enrollment for now. But if we cap it, we'll most likely reopen in like 1 to 2 weeks if we can handle the volume that is running through the website. Again, the website is drippy.finance. Be sure to check it out. And feel free to check out the other free content I provide on my channel as well. My goal with DeFi is to help people like you avoid the stupid mistakes that I've made and run strategies that have like really good risk and reward so that we could all make more money and lose less money in the process. Thank you once again for watching. I'll catch you next time.